Thank you for joining us for the 2023 quarter four Klaas Financial client webinar. We are going to be doing somewhat of a year in review today, also with a look towards the future here. I'm Eric Schwartz. I'm one of the advisors here at Klaas Financial. I'm joined by Josh Stirling, our Director of Portfolio Management, and Kite, another one of our advisors, and also our CFO. So we are going to be looking today, we're going to be splitting our presentation into three parts. So we're going to start with what experts and everybody expected for 2023. We're going to talk about what actually happened in 2023. And then we're going to look at some of the thinking going forward into 2024 and what we might see coming up here. Before we dive into that, I wanted to do just a quick overview for our new people or people who just may have forgotten a quick overview of Klaas Financial. We have been in business here about 48 years, and we serve just over 1,000 households across 32 states. And we manage about $682 million in client assets. And we do that from our two office locations, one here in southern Wisconsin and then the other in northern Illinois. Now, Josh, I said we're going to start with what people expected to come out of 2023. So let's dive right into that.
Yeah, so let's talk about 2023. And before we jump into it with Eric here, there were a lot of interesting predictions on 2023. 2022 was a very interesting year. We had massive interest rate hikes throughout the year. We were combating some of the biggest inflation numbers that we've seen for decades. And so predictions were a little wild on what's going to happen in 2023, but they were mostly negative. So here what we have are a couple of headlines that we gathered as some economists, some market traders were looking at what's going to happen potentially in 2023. And we saw a lot of interesting thoughts on what might happen. There was a lot of conversation about what the Fed might do, handling yields in the markets. A lot of economists were predicting that there was going to be a recession in 2023. A lot of the conversation was on a mild recession or maybe a slightly moderate recession, but still predicting a recession either in the middle of 2023 or towards the end of 2023. And then one of the other things that we saw was that Wall Street was making some interesting predictions on what might happen in the bond market and what might happen with the Fed. And they were especially betting on that the Fed was going to make interest rate cuts. Some of the predictions were saying mid-2023, while others were basically guaranteeing that we'd see interest rate cuts by the end of 2023. And these were pricing into the market as well. We were seeing yields kind of predicting that that was going to happen by the end of the year. Of course, that's not what we saw. That was actually further from the truth because we actually saw more interest rate increases throughout 2023. But let's start to take a look at what kind of happened in 2023. So some of the big topics that we saw were around inflation and the interest rates that the Fed were kind of controlling. So one of the big benefits that we did see was relief from the growing inflation. And essentially what we mean by that is kind of looking back in 2022, you had inflation numbers peaking out around 9%. And so you started to see that come down as we were approaching 2023. But our inflation rate was still really high. You were up in the mid 6%. And our hope was that we were going to continue to see that go down and not kind of stagnate around 4, 5%. And luckily, what we actually got out of 2023 might not have been as good as we would have hoped, but we saw inflation come all the way down to about 3% by the end of the year. So what we're looking at right now on the screen, you can see that inflation rate is the reddish orangish bar graph in the background. And you can see it starting off there at the beginning of the year, starts to step down throughout the year. And then it kind of flatlined towards the middle part of the year towards the end. Had a couple of jump ups and a couple of jumps down. And that's really kind of as we're starting to see some of the effects of the Fed raising interest rates just start to get baked into the economy. But of course, like we talked about before, the market was predicting that we were going to see interest rate cuts happen. There was a lot of people wondering that has the Fed already overbaked what's going to happen in the economy? Is the economy just going to suddenly start coming crashing down? But that's not what we saw in 2023. And not to spoil it a bit, but Eric will talk about how the markets reacted towards the end of 2023, and it was quite good.
One thing I will just point out here, I know I've heard this from a lot of clients and from people just generally. We talk a lot about inflation slowing down, but what I hear from a lot of people is, well, prices are still really high. And this is, of course, true. What we're talking about when we're looking at inflation moderating is we're looking at the increase or the growth in expenses, the continued growth. If we were to look back, 2 years ago, yes, prices are definitely higher compared to then. But what we're talking about here is the increase, the ongoing increase in prices, which is really how the Fed is kind of evaluating what they're going to be doing, with interest rates. So that's really why we focus so much on inflation.
Yeah. And so in partnership with inflation, one of the biggest tools to combat that is the Federal Reserve increasing interest rates. And so the blue line that's going across, kind of starting at that 4%, having a bunch of volatility throughout the year, and it ends at about the exact same spot. But that is kind of the reality of the Fed continuing to raise interest rates a little bit throughout the beginning part of the year, and then stopping around July. But then you see that the interest rates kind of flatlined throughout the year almost. This right here is just the 10-year yield. It's kind of the average rate that you could receive in the market. And we saw that roughly around the 4% rate throughout the entire year. In June, we saw something pretty welcoming in the market, where you saw that interest rates finally surpassed inflation, meaning that for every dollar that you're spending at the store, you could now have that money invested in a bond, and you're actually getting paid more than what it increases on eggs, milk, gas. We finally surpassed that moment, and that was something that was a big target for the Fed, reducing inflation enough to make our interest rates that we're earning real, that we're finally surpassing that inflationary rate. The last thing that I'll point out on this graph here is the Fed target inflation rate. It's kind of that greenish color towards the bottom, and it's that 2% number. So that's the Federal Reserve's long-term kind of annualized inflation rate target. That's where they want to see inflation get down to. And right now we're kind of hovering around that 3% rate. So while we saw a really good reduction in that year-over-year change in prices, we still have work to get done. This is the reason why we might not see interest rate reductions happen really quickly. That's why we haven't seen one happen since July, when the last interest rate increase happened. So there's still more work to do to get down to that 2% rates, but we're improving little by little.
I think the struggle is that the really stubborn part of inflation is housing or shelter costs right now, which is a much longer term fix. So that's figuring into the overall 3% or currently about 3% inflation rate, but it's almost overshown in the data here. So.
Right. I think we've been a little negative on some of these.
We have. Let's talk about what happened last year. Yeah. So it did end up, as Josh was alluding to earlier, end up being a really strong year for both the equity and the fixed income markets. It may not have seemed like it at times, because basically a bunch of the growth came in the last 2 months of the year. I think we had our second best November market performance in like 40 years. And I'm sure a lot of our clients noticed that on their statements. But by and large, we ended up having a really strong year of returns. A number of reasons for that. You can see there the NASDAQ was up 44.6%. So that is a lot of tech stock impact there. So tech stocks and growth stocks in general really led the way. Stronger than expected corporate earnings really kind of raised all boats, so to speak, in the equity markets. You can see in the mid and small space, we had a strong year as well. International stocks followed suit, especially in the developed world. We saw some good returns, and then the moderating of Fed interest rate increases really boosted the fixed income markets as well. You can see there we got about a 5.5% return on the ag in 2023. And that was actually important because we avoided a third straight year of negative returns in the fixed income market, which is something that has never happened in recorded history. So it's nice to see us getting a little bit of return on those lower risk assets.
Yeah. And a lot of that return really came from the higher yield environment that we're in. It's really clipping the coupons, getting the interest payments that are coming in. The portfolios right now that we have, our bond portfolios, are paying about 5%. So that's where the vast majority of the return came from in that fixed income world. It's really been a big shift, and it's been a welcomed shift. We haven't had rates like these for decades, and I think they've really helped to kind of buoy the 60/40 portfolio over this year.
Yeah, and I think that's especially important for our retirees. I mean, since the financial crisis in 08, 09, we really haven't seen yields that are significant in the fixed income space, which has led a lot of retirees to need to seek out more exposure to stocks or the equity markets because they're trying to create yield and create return. In this environment, like you said, Josh, we can see those higher yields on the bond side of the portfolio, which creates some more income for folks who are in retirement.
Absolutely. I think one of the most interesting things that we saw, kind of getting a little nuanced here on the returns, but one of the big headlines throughout the year was the top 7 stocks in the U.S. being such a major driver of the overall returns in the market. And that was really true all the way through about June, July-ish time. I believe the markets were up 17-ish% in the S&P 500. And if you took away all of the top 7 stocks, you would have only been left with about 4 or 5% returns. They really did build up the vast majority of the returns. Towards the secondary half of the year, we finally saw the other part of the markets catch back up. I mean, you see small cap, mid cap, the international markets all really boosted the returns towards the end of the year. It was no longer just the behemoth stocks in America. You really did see kind of an equilibrium in the markets rising above.
Yeah, this is one that I was pretty excited to talk about today, mostly just because early in 2023, the death of the classic 60/40 portfolio was widely discussed. 2022 was as we've talked about, a tough year in both the equity and the fixed income markets, which exposed our more moderate investors, people who might be in something like a 60% stock, 40% bond portfolio, exposed them to larger losses than historically they've been used to seeing in their portfolios. So a lot of the discussion naturally early in 2023 was about what's next, what is the new retiree investment portfolio, and lo and behold, the 60/40 had a banner year in 2023. So it had its best return since 2019, and it returned nearly 18% in 2023. So had a kind of a masterful comeback. Now that was boosted by a lot of the things that boosted the rest of the market, right? Moderating Fed policy, so interest rates not being raised, and then sort of keeping them steady, and that the equity performance that we just talked a lot about also helped out the 60/40. The interesting thing for me was looking at how the 60/40 portfolio performed compared to other other portfolio strategies. And what we found is that just the classic balanced portfolio actually performed better than most what we would call more tactical strategies. So strategies that are trying to buy and sell and sort of outperform or outsmart the market. So beating the market and outsmarting it was not very successful in 2023. And I think we've talked about this enough here, and with our clients, talked a lot about it as well. At Klaas Financial, we favor a more structured approach to asset management. We think it's important that clients have more time exposed to a strategy versus trying to time the market and get in and out. And we see the benefits of that often, but we definitely saw it a lot in 2023.
Mm-hmm. And to kind of hit the final point on here, on the screen that we have up for you, we spread out the returns over an entire 2-year period so that you can kind of see, while 2023 was a pretty incredible year across the entire market, we still have a little bit of work to do to get back to kind of the break-even point from the reduction that we saw in 2022.
Sure.
We're not blind to that. It was a pretty rough year to go through, both in the bond and the stock market, but we're getting back. We're getting closer to that kind of break-even point. We hit it slightly a little earlier in the year when just looking at the stock market, but our traditional 60-40 portfolio is pretty close, and it's really, really well positioned with the current fixed income interest payments that you're receiving on it too. It's poised really well right now.
Yeah, and I think a big thing to point, Josh, is back in at the end of 2022, and we were down in the depths of this. This really, bottomed out in October of 22. We had a little bit of run up in November and December. But if we were to rewind to a year ago in January of 2023, and we would have said, coming off of 2022, you're going to make roughly 15% 12 months later, most people would have signed up for that hands down, because 2022 was just so brutal for these types of portfolios. So while the ride this last year was a little bumpy, it still ended up in a really nice spot. And that's why we're all feeling a little bit better about it going forward as well.
All right. So we've talked a lot about kind of what the predictions were, what actually happened, but let's talk about some of the things we're interested going ahead.
Yeah, of course. Predictions are fun. We all know that. But as you can see, they're wrong quite a bit of the time. So we are no way making predictions or anything like that. But it's just things to be aware of, what could really, be really good for the market, or, kind of throw a bump into it. And it's still the interest rate decisions. So this is going to be the story throughout the year. Like we said, last year, a lot of people were predicting that they were already going to be cutting by this time. Fast forward into this year, the market is still predicting that the Fed does some rate cuts, and actually they still think that it's going to happen fairly soon. There's a study that comes out every month, I think it is, and the market is anticipating a 60% chance of a rate cut as early as March of 2024 here, which is interesting to hear. Especially, I was reading an article today. One of the members of the Fed board came out and said he doesn't see it until third quarter of 2024. So this will be a battle that we're going to continue to hear throughout the year, of what the market thinks the Fed is going to do versus what the Fed is actually going to do. But as of right now, as we were talking, they don't really have a big need to cut rates at this point. Unemployment rate is hanging in there pretty good. Inflation seems to be in a moderate level. While it's not down to their 2% target, 3% is a more historical average for inflation if you go back over a long time frame. So I think those are probably going to be the two things that are going to have to, so you're going to have to see something there to force them to want to cut rates and things like that. But these things are obviously very sensitive. I know a lot of people, like we said, housing market is a big thing, and the 30-year interest rate for a fixed mortgage bounces all over the place when any of these rates move. So I know back in November-ish, it was a 7 to 8% 30-year, and now it was down to 6% up until the last couple of weeks. So it does move around quite a bit. So you're going to see some fluctuations here, but the Fed continues to hold their stance that they're going to be data dependent and just kind of wait and see how this continues to play out. So. And so with inflation, obviously, this is kind of one of the big drivers of what they're going to do with interest rates. And as Eric alluded to earlier, housing still continues to be, I guess you would call it stubbornly high, and that it is a slow moving industry. It takes time for those rising interest rates to impact the market, the housing market, of course. But it is still a supply issue. If you guys have, I'm sure any of you that have kids, grandkids looking for houses, it's still hard to find a good house. There's just not a lot out there. And if you do find a good one, they're still selling fast and they haven't completely deterred people. So it's certainly ground to a halt from what we've seen back in, 2021 timeframe, but houses are still moving and costs are starting to come down finally, which you'll notice here. You look back to it peaked in about February of 23, it has come down, but again, this just takes a long time. And that's probably one of the main reasons why the inflation number continues to stay in that, 3 to a little bit over 3% range. It just takes a while.
Yeah, it's been interesting watching kind of this wage growth situation, and just the workforce in America has just really been a strong force that's just continued to grow, continue to be just a positivity in the economy. I just saw numbers released earlier today talking about the lowest jobless claims, or the new unemployment claims going down, continuing to go down, really just showing that part of the market's not slowing down yet. So you're really seeing these driving factors continue to push the economy forward, showing that these interest rates have possibly not baked in yet. And so it could take longer than markets are predicting. I think we might have already commented on it, but interest rate reduction was initially planned for March.
Yeah.
Now it's a coin flip on if the Fed's going to reduce rates during March. And we said this back in the start of 2023, markets could be wrong on this. Don't be surprised if we get towards the middle of the year and we're still saying the exact same thing. We, of course, can't predict it, don't know. It's a data-dependent Fed. They're waiting for numbers to come out to show proof that things are changing and moving in the direction to reduce inflation, while making sure the economy kind of still floats in.
Yeah, and I think for me, one of the really positive things in it, because obviously there's a lot of unknowns, but the Federal Reserve has, as we've said, they promised to be data dependent in making these decisions. And I think up till now, we can all say they have really stuck to that. And at times that can be difficult to do. These decisions are not always popular, but the Fed has really stuck to their strategy. And to me, that's a really hopeful sign as we're kind of trying to navigate all of this.
Yeah. Now they're not perfect. They definitely took a little too long to kind of really address the inflation issue.
Sure.
But they're doing good work right now. I think they have a really difficult tightrope to walk right now on when to start reducing rates. So it's one of the top things we're going to be watching for over the coming quarters.
All right. The other big thing, of course, that will happen this year, we're already starting to see a lot of different commercials and all that kind of stuff as we have a presidential election coming up. This is always a question that we get of how the market does in election years. So we wanted to kind of throw this graphic on there. So again, 2023 would be in this far right column, non-election year, no midterm or presidential election. It was a really strong year at 14.5% historically. And obviously last year was even better than that. But if you look kind of in the second column from the left over here, you'll see presidential election years. So, and this data goes all the way back to January 1st of 1926. So you can see that it's getting close to 100 years. So this is part of the reason why we say that the market is fairly agnostic to when it comes to presidential elections and certain political things that happen. In all presidential elections years going back to 1926, the market has been up about 11.6%. So many people find that a little kind of shocking. They think that, oh, just because it's a presidential election year, that's going to mean the market's going to, go down and this kind of stuff. And actually, that's not the case. Doesn't mean that there won't be more volatility as those headlines start coming out in October, November. So this is something that will continue to kind of push data throughout the year of just, there's all kinds of data points on these things when it comes to election years and past performance of the stock market. Of course, the past does not predict the future, doesn't know what's going to happen this time, but it is nice when you're looking at almost 100 years worth of data that it's actually been positive. So.
I feel like this is the question that we've been starting to see ramp up.
Yeah.
And it's going to be a little relentless throughout the year. And it's good to have nice normalized reminders of just because it's an election cycle does not necessarily mean negative returns. It'll be an interesting year to see how all these things play together.
It will. I think, as we've said, we are starting to get this question a lot more, and we do every time that it's a presidential election year. But I think for us, it really comes back to our view of it is very difficult to time the market and to do it consistently. And what we've seen in, what history has told us is that trying to jump in and out of the market when you're concerned about volatility or you're concerned about an upcoming event really does not provide a whole lot of return. Actually, it often provides negative impact to the portfolio. Mm-hmm. So while it's a different topic than interest rates or inflation, it's just another one of those things that was part of the journey of investing.
All right. Well, that completes some of our prepared comments. We're going to move on to some of the Q&A that we have. We have a couple of questions in the queue, but if you have any questions you'd like us to address, please go ahead at the bottom, hit the Q&A button, and go ahead and enter in your question. We'll answer those off here shortly. So let's go ahead and take a look at some of these. And I already see a very entertaining one about some recent news that happened. So are Bitcoin ETFs safe to use? Can I put this into my portfolios? So for those who have been tracking Bitcoin closely, you might be aware that last week we finally saw that the SEC approved the use of Bitcoins inside ETFs. And so we saw about 11 Bitcoin ETFs come out last week. And the market was pushing it. It was going to be a really interesting thing. So it's been out for about a week. Very new, very, very new. But Bitcoin's been around for a while. We have had a handful of clients go ahead and take a little bit of money and invest it in Bitcoin. But it's been relatively stagnant for a while. Since the ETFs have come out, we've seen a bit of a reduction in it. But Bitcoins and cryptocurrencies are something that we view as not being necessarily a part of the Klaas Financial portfolios, as they don't have the traditional characteristics that we look for when we look for return-driven solutions like stocks and bonds. So from the outset, it's something where if you would like to use those, you can connect with us and we can chat about it and kind of make sure that you're not looking at anything that's too risky, that shouldn't be held for a long-term time period. But if that's something where if you had a couple $1,000 and you wanted to go ahead and invest on that in yourself, that is something you could do.
Yeah, I think it goes back to the folks that we work with and the type of work that we do, right? We work with retirees. We help individuals build retirement income plans and things like that. So we really are hesitant to jump into something like this that is maybe a new fad, I guess you could say potentially. We prefer a more tried and true approach because we are at the end of the day investing for retirees, and we need to make sure that we're doing that in a prudent manner.
Mm-hmm. All right. So let's take a look here. We have a couple of other ones here that are asking a little bit kind of about the digital currency, but I'm going to try to talk a little bit more about this one that goes a little bit deeper here. So talking about some of the news articles that are coming out about stories on implementation of digital currency kind of being a vehicle for confiscation of 401ks, banks confiscating savings accounts. Maybe Kyle or Eric, maybe you might want to address this real briefly, if it's a big concern or if it's something that people should be aware of.
Yeah, I think, Kyle, maybe you can comment on this after too. I think where I've primarily seen stories like this tend to be as part of a sales pitch for what might be like an alternative investment. So thinking like precious metals, gold and silver, or just something that might be more of a non-traditional type of investment. So I tend to view things like this as sort of more like fear mongering to some extent to sort of push people to the perceived safety of an alternative investment. So I tend to be less concerned about that because it feels like there's an ulterior motive linked to it. But Kyle, I guess, do you have any other thoughts on that?
No, I think you're pretty much in line with what I would say too, is that, anytime you see those, they're essentially sales materials for the most part. And that's, fear is one of the biggest emotions that they try to stoke to get people to take an action, which again, it's usually gold, silver. We've seen it from, life insurance companies over the years of, buying the 401ks don't work, buy life insurance instead and all this kind of stuff. And it's just, like Eric said, to think that, they're actually going to confiscate 401ks, I have a hard time seeing that. Anything can happen, of course, but I would say it's not a high on our priority list or radar of things that are possible in the near future, anything like that. So you just have to, with all of this kind of stuff, you have to do your due diligence, run it by us when you see these types of things. Because generally speaking, especially like the gold and the silver and things like that, if you read the fine print on that advertisement, they own a gold brokerage and they'll be happy to sell you some gold and that kind of stuff. So just be extremely careful of that. So.
All right, let's look at this next question here. So the impact of wars on 2024 performance. I think this is a interesting question here. And I think, again, this is something that is hard to predict because you have to look at the magnitude involved economies. There's a very large global scale that you have to look at this from. Is it something that has happened more recently? Russia, Ukraine, the fights currently happening between Israel and Palestine. Those are things that, of course, have a big impact on people that are local involved in those pieces. You can see the performance that we've seen in our portfolios. I mean, they've been relatively positive. They've been able to sustain beyond these wars that have kind of broken out. So it really, when we look at it, it's kind of what the scale is of that. That would really drive home what kind of could be the impact to the market performance.
Yeah, it seems, I think you can look at perhaps the two most recent conflicts that we've seen. And, the first being the still ongoing war between Russia and Ukraine. And there was a lot of, just given the two countries that were involved in it, there was concerns about the impact of Russian oil exports on the greater economy. There was concerns about the exports that Ukraine has, grains, things like that, that were going to negatively impact the economy. So really, it's more about I think the actors involved than necessarily the fact that there's a conflict or not.
And when we saw that happen, the severely disrupted supply chain, you see other solutions come forward. I mean, this is a global economy where other players can step in and help take over.
Sure.
Of course, that doesn't always necessarily mean favorable pricing down the chain, but other individuals can come in and help kind of sustain that supply chain and reduce the disruption that happens from that outbreak.
Yeah, I think it's hard to say, to be very honest, and that feels kind of like a little bit of a cop out. But I think it really comes down to the players that are involved in the conflict in terms of how the global economy is going to react.
Yeah, it's the players and it's also the scope. And honestly, this is geopolitical risks are probably one of the biggest risks to the stock market because they can happen just out of nowhere. So it's always one of the unforeseen things a lot of times, and that can certainly disrupt the market. So I was actually reading ahead, and one of the questions was, what are some primary indicators to watch that would negatively affect a soft landing? So as of right now, some economists are saying we're pulling off the soft landing, meaning we did all these interest rate hikes. Unemployment's holding pretty steady, inflation's under control. So they feel like we've got this soft landing as a kind of a might happen and is happening right now. Things that could negatively impact that, geopolitical risk, which is why I went to this question, that could certainly throw a wrench into that. But also it would be like a re-acceleration of inflation, meaning that the Fed would probably look to hike rates again. That could throw us, into a more of a bumpy, so I've heard this bumpy landing thing too, if unemployment comes up, things like that. So it's going to be something along those lines. I would say that would be the likely cause for this to kind of throw a wrench into what we're looking at is geopolitical, re-accelerating inflation, some things like that more than anything.
Yeah, I would also say that the job market is something that we'll be watching for and could be a clear indicator that something's wrong. If we suddenly see the employment rate jump from its current 3.6%, roughly right around the 4%, and we see it pop up to 5%, 6%, 7%, something is accelerating in the economy. Companies are starting to lay off more than we traditionally see. We've started to see some normalized kind of turnover happen at a lot of software companies. We've started to see headlines come out at the beginning of this year. Nothing seemingly out of the ordinary from traditional years of just turnover in the beginning of the year for public companies. But you are starting to see occasional bits come out about larger companies laying off 3% of their workforce, as high as 10% of their workforce. These primarily are coming from public companies that are doing this to trim expenses, increase revenues, and increase profitability. We see that in the results of returns over time. So it is a direct impact to the individuals and, of course, the job market.
And I think if you were to ask those organizations, they would say it's still largely a lingering impact of overhiring during the pandemic, right? And we've not had a global pandemic in a long time. In most of, pretty much everyone's lifetime, we haven't had this level of disruption. And I think that did impact the job market. And I think perhaps what we've seen in these recent layoffs is more a function of sort of that adjustment back to normal.
Mm-hmm. All right. Well, the final question that we have here is around the national debt. Are you concerned about the growing national debt? I'll leave you to start that.
Kyle, you want to take that one?
Yeah, it's a good question. Obviously, that is obviously something that's on a lot of, it's a hot topic, in all different things. But it's interesting because the government still owns the printing press, and they still control those interest rates. So, is it a cliff or whatever they want to say? Well, I don't think that would be accurate, maybe, but it could certainly. It's a concern to be aware of, but I don't know that the stock market is going to crash just because the national debt continues to grow at that rate that it's been growing. So,
this kind of off the cuff, this might be an idea for a future slide, but there are other economies in the world that are similar to ours, developed nations, that have survived off of, the ratio that you look at is a debt to GDP ratio.
Right.
And the big thing right now is that we're over 1 times, over 100% that. And so it's looking at that, is that the cliff? Is that where we're finally going to stop being able to pay our debts and we're going to really start running into issues with servicing the interest, servicing the payments? But other economies have been able to survive on a higher debt to GDP ratio for long periods of time. Might be a good idea for a future slide, but it is possible to sustain.
Yeah.
Now, maybe not forever, maybe not an ideal world, but
right.
you have essentially two simple options at addressing it. You raise taxes or reduce spending.
Right.
And one way it's going to have to be addressed if this is a national topic that the voting power wants to see changed. And I think we do see that happening. So it's going to have to be addressed, hopefully in the next decade, maybe 2 or 3, but could be a long standing continuing conversation.
Yeah.
All right.
Any more questions?
I think that's all the questions that we have this time. So thank you everyone for joining us. We greatly appreciate your trust that you have here with Klaas Financial and the team here. We will join you at the next quarterly webinar coming up here. Be on the lookout for that invite. Thanks everyone.
Thanks, everybody.